Hello everyone and welcome to another video where we are getting solved with the FM Pre-June 2025 mock exam. This happens to be one of the most important papers to practice if you people are appearing for FM in the June 25 attempt. So without any further ado, let's get started. In this video, we are going to be practicing one section B question. So this is the first case study of your FM Pre-June 2025 mock. The name of the question is Ernst Company. This is what we're going to be solving right now. All right. We are going to be given with, you all know the drill. You're going to have 5 case study questions, which are going to be based upon this case study that we have on the left-hand side of the screen. And on the right-hand side, once we keep going next, once we keep navigating to the next question, we'll be asked with 5 questions which pertain all of this to this case study. So let's read the case study once. Ernst Company is a well-diversified company that has successfully grown over the years by adopting the strategy of inorganic growth. What do you mean by growth? Growth are of two types. Growth means you grow by leaps and bounds. Your revenue increases, your profit increases, you increase in size. So growth can happen two ways. One way is called as the organic growth, where we are working very hard, where we are, putting in lots and lots of efforts, and because of that, we are growing. And another type of growth is the inorganic growth, where we are growing by leaps and bounds. We are growing our companies, we are growing our size that the business operates at by the way of mergers and acquisitions. So they are following the second route where they are going through with the unorganic growth. So you can see here, 3 acquisition opportunities have been identified as follows. Small company manufactures parts for automobiles. The extract from its statement of financial position on 31st March 20x4 is given below. Non-current assets, current assets, inventory, receivables. The non-current assets include goodwill of $250,000. The other non-current assets are considered worth 80% of their book values. The inventory is net of an obsolescence provision of $40,000. Okay, so this all will relate to some of the requirements. Then they have talking about the medium company. And then the third opportunity which they have thought of could be the alpha startup company. So these are all the opportunities which they have with us. And now we are going to answer the questions based on this particular case study. So the very first question that has been given to us is, why is the valuation of equity of a company necessary? So whenever you start studying this concept of business valuation, wherever you study from the Kaplan, from BPP or the Study Hub, whenever you start off with this unit or this chapter, you people are given with the reasons why companies will want to take up valuation. Why would they want to know how much is the value of a company? So you have already learned the reasons. Let's see how many of them fit into those reasons which we have studied. First one says the company is planning to raise equity finance in the primary market. Of course, yes. So if you are an unlisted company, you are going to the primary market. That means presently you're an unlisted private company and then you want to get yourself listed in the stock market. So this is where you will have to know how much is the worth of your company. So first is absolutely correct. Second says the company wants to establish the terms and conditions for mergers and acquisitions. Mergers and acquisitions again means when we are trying to merge, we are trying to bring two companies together, or we are trying to buy out another company. So that is what an acquisition is. So if these all the things are happening, then also we are definitely going to need the valuation of equity. So 1 and 2 both are true so far. Let's give the third statement a read. The company has the primary focus on mission-driven activities and no profit motive. Now, if you do not operate for the profit motive, you're not going to need your valuations done, because valuations are primarily needed by profit-making companies. Statement C, the third statement, intends to be of a not-for-profit motive. So option 1 and 2 only are going to be our answers. Let's move ahead to the next question. Question 2 wants us to calculate the asset value of small company using the net realizable value basis to the nearest of thousands of dollars. So this is the information. This is where it starts about small company. Small company manufactures parts required for automobiles. The extract from its statement of financial position on 31st March is given below. So they have non-current assets, inventory and receivables under the current assets. And we have some further information also which has been given to us in this regard. So we are given with the non-current assets include a goodwill of 250,000. The other non-current assets are considered worth 80% of their book values. Now, you people would know that goodwill is not really considered to be an asset. Whenever we're finding out the value of any company, we ignore the goodwill as a part of our calculation. So to value our non-current assets, we are going to start off with the non-current assets amount, which is 1275. You take away from this value the goodwill of 250,000. So this is what you're left with. And it tells you the other non-current assets. That means the non-current assets apart from goodwill are considered worth 80% of their book value. So 1025, what we are thinking, this is only 80% of their book value. So 820 is going to be the value of our non-current assets, which we will use for the purposes of our calculations. Then it says the inventory is net of an obsolescence provision of $40,000. Going forward, the obsolescence should be brought down to $20,000. So remember this amount, first non-current assets, we have gotten the answer as 820. Then the next thing we are going to do is find out the value of our inventory. So for inventory, we say that 280 is what we have written. Now this 280 we have come out after subtracting the provision that we have made. That means the original value of my inventory is 320. But now again, I want to create a provision which is of $20,000. So I take away 20 from this, and 300 is what I will be taking as the value of my inventory. So 300 is my inventory. Then let's come towards the receivables. It's worth 520. And it tells you the receivables are expected to yield 90% of their book value. So 520 times 0.9 will give us our value 468, and to this we are going to add 820 and 300. This will give us our final answer. So I add 820 and 300, 1588,000. This is going to be our answer. Because 3 zeros have already been given here, so I'm not going to put any extra zeros. 1588 is going to be my final answer. So I enter this into my answer and then I move ahead. The third question wants me to calculate the market value using the PE ratio method of the ordinary share of medium company to the nearest of 2 decimal points. So information with respect to medium company is given to us here. Medium company is an unlisted company engaged in manufacturing of parts for the aerospace industry. It earned profit after tax of $850,000 during the year just ended. It has 1 million ordinary shares, nominal value of $1 each in the issue. A listed company engaged in the same sector has posted an EPS of 1.2 and has a PE ratio of 10. So if I want to find out the market value using the PE ratio of the ordinary share of this company, so then I can use the PE ratio of the industry who is engaged in the same sector. So I'll use the PE ratio of 10, but I'll have to use the EPS of medium company. So with respect to medium company, it has been given to me that 850,000 is what they have earned, and the number of shares. How do you find out the EPS? You take the PAT and you divide that by the number of shares. So you see how many will be the number of shares here. You are given with 1 million ordinary shares in the issue. So 1 million is the number of shares. 0.85 is what is going to be your EPS, earnings per share. PE ratio, how do you find out the value? You take the EPS and you multiply that by the PE ratio. So EPS we've already found out to be 0.85. You multiply this by the PE ratio of 10, and 8.5 is going to be our final answer. Because they have asked to write it in 2 decimal places, we are going to enter 8.50. Please be very careful with these small details. Then let's move ahead to the second last question pertaining to this case study. Which of the following currently represents the value of Alpha's startup company using the discounted cash flow basis? So Alpha startup company, this is the information pertaining to that. We have to find out the value of the company using the DCF basis, discounted cash flow basis. So firstly, let's read about this. Alpha startup company is engaged in software development. Its new software is fast becoming popular and the market seems to be promising. The cash flow projections for the coming years are given below. Year 1, 2, 3, 4, these are the cash flows. Post year 4, the cash flows are expected to rise by 2% perpetually. The cost of capital is estimated at 11%. So for 4 years, we know this. And then after the fourth year, your cash flows are going to rise 2% perpetually. So like you're going to receive money every year till the end of time. That's what a perpetuity is. And this money is not going to be constant. It's going to keep on rising. So let's first, our calculation over here is going to be divided into two parts. First part is where we calculate the PV of the 4 years cash flows which are readily given to us. And then the remaining part about the perpetuity, we will find out the value of that. So you add both of the values, that is what your final answer is going to look like. So let's first calculate our values for the first portion where the first 4 years cash flows have been given to us. We are going to need the help of our formula sheet here. These are going to be cash flows that we receive and we are going to have to find out their present value. So we head to the present value table. We are given with the estimated cost of capital of 11%. So for 11%, these are what my factors look like. So for the first year when I'm receiving 130, 130's present value will be multiplied by 0.901 plus second year's cash flows are 180. So you multiply this with 0.812. Then you take for the third year, which is 210. This will be multiplied with 0.731. And then you take for the last year, 240, which is going to be multiplied by 0.659. So this is the first part of our working where we have worked out the calculation pertaining to the first 4 years. So we can note down this figure with us on our scratch pad. So it's going to be 574.96. So this is the first part of our working. We now need to add the present value of the perpetuity. And then if we add both of the answers together, we will arrive at our final answer. Now, how do we work out the PV of a perpetuity? Now, we could have simply used the perpetuity formula, but the thing over here is that the cash flows are not the same every year. Simple perpetuity formula, cash flow divided by the rate of interest or the cost of capital, works only when the same amount of money is received every year. But now our money received is changing every year. It's growing by 2% every year. So we are going to use the formula which is going to help us find out the value of perpetuity at year 4 using the DVM formula. So you have learned the DVM formula. You take D0, you multiply that by 1 plus growth rate. You divide that by the cost of equity minus the growth rate. So we are going to do the exactly same thing here. Numerator is going to be 240. This amount is going to grow by 2%. So into 1.02. And this needs to be then divided by your cost of capital. My apologies, 240 times 1.02. And this needs to be divided by 11%, which is your cost of capital, minus, it's not letting us enter the percentage sign. So let's take it 0.11. 240 times 1.02. 1.02. And your denominator is going to be 0.11 minus 0.02. So this is the present value of the perpetuity as on the fourth year. Now we are finding out the value today. So the money that you receive at the end of the fourth year, it's going to have a lesser value today. So how much is this money 2720 worth today? You discount this using the factor of the fourth year, which is going to be 0.659. So you multiply this with 0.659. 0.659. So this is what you're going to get, 1792.48. And now we are going to add the earlier part of our calculation, which was 574 574.96. So this is what your final answer is going to look like, 2367.44. Here they have asked us to round the answers. So we are going to select the nearest one, which is going to be the last option, option D. So this is how we calculate the value of alpha startup company using the discounted cash flow basis. Now we move ahead to the last requirement that we have as a part of this case study. This question asks you which of the following is the correct way to calculate the market capitalization of a listed company. What is market cap? Market cap is basically the number of shares that the company has, multiplied that by the price at which the shares are trading in the market. So let's see which of the options are correct here. Number of ordinary shares in the issue multiplied by the current market price per share. This is absolutely correct. Let's also see why the other options are incorrect. Weighted average number of ordinary shares in the issue multiplied by the current market price per share. You do not really need the weighted average, or the next option also takes you for the number of ordinary shares multiplied by the average share price. We do not even need the average share price. This is wrong conceptually. And the last one says you need to take the number of ordinary shares, multiply that by the current market price, and then you need to add the MV of debt. You never add the market value of debt in the market capitalization. So only option 1, that is our correct answer. So in this video, we have solved Ernst company. In the next video that we meet, we are going to solve the next question, which is related to McGregor company, where the question is based upon the Forex unit. So the risk management unit is tested in the next question. I'm going to meet you for that. Thank you for watching. All the very best.